Hi, you're listening to Stephan Livera podcast, a show about Bitcoin. So today I am in Dallas, and the last few days I've been in Austin and in Dallas. It's been great to meet the Bitcoiners out here. I've met many listeners as well. And so I'm here for BitBlock Boom, and so today is the workshop day, and then tomorrow is the actual conference day. So I'm looking forward to that also. So today, for episode 303, we have Alex B joining me, and we're talking about Ethereum's path to centralization. So being honest, I think Ethereum is a shitcoin, but are there ways that Bitcoiners can offer intelligent critique? And so today we talk about a range of things like MEV, can it be stopped, the interaction between MEV and staking derivatives, Ethereum as the Myspace, and why Ethereum cannot be ultrasound money. So these are some of the ideas that we get into in this show. This show is brought to you by Swan Bitcoin, and one interesting and important aspect of Swan is the education factor. So Swan is actually focused on trying to teach your new coiner and pre-coiner friends about Bitcoin. So for example, Jan Pritzker's book, Inventing Bitcoin, which is an excellent resource. It's a short read, and it gives people a little bit of a technical explanation of some of the concepts behind Bitcoin, and Swan is providing that for free. So if you want that, go to swanbitcoin.com/free book. So make sure you send that to your family and friends so they can learn about Bitcoin. And then obviously they can set up an auto stacking plan, or if they're a high net worth individual or a company or a business, they can sign up with Swan Private. So if you're interested in that, send them to swanbitcoin.com/free book. Are you interested in peer-to-peer Bitcoin lending? Lend at Hodl Hodl is a peer-to-peer Bitcoin-backed lending platform. So you can lend out stable coins, or if you have Bitcoin, you can borrow against your Bitcoin. It's the collateral as part of the loan. So this is a global and anonymous solution. You don't have to do KYC. So think of it like this. If you've got Bitcoin and you need some liquidity, you don't have to sell now. You can actually borrow against that. And you still hold one key in that 2 of 3 multi-signature. You know there's been no rehypothecation, and you can see that the money literally has not moved. So Hodl Hodl does not hold your funds. Lend at Hodl Hodl is a peer-to-peer lending and borrowing platform. So you go there, you set your own terms, put up offers depending on how long you want to borrow or lend and the interest rate. Go to lend.hodlhodl.com. Are you interested in Bitcoin mining but you're not sure where to get started? Compass Mining can help you. So Compass Mining helps you by making ASICs available for you to purchase, as well as having vetted facilities that they have looked into. So you can select an ASIC, select a hosting facility, and join a mining pool and start receiving sats. So you'll pay upfront for the miner and pay the hosting costs and electricity, but otherwise this is an easy way to get accessible costs of entry into the Bitcoin mining world. So if you're interested, go to compassmining.io and sign up. On to the show. Alex, welcome to the show.
Hey, Stephan. Happy to be here. Excited to do this.
Yeah, so Alex, I've been following you online for a while. I know you've been around the Bitcoin space as commentating on things and writing as well, and tweeting about things. Do you want to just give a bit of a background for listeners who don't know you?
Yeah, for sure. Yeah, I've been pretty involved. I would say, I guess I started my journey around 2013. Got pretty active on the related social medias and forums, I guess Bitcoin Talk and Reddit early on, which eventually actually led me to all of it. Obviously, all of that ramped up as the sort of block size debate started picking up. And that's when I started getting very, 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 very active. And that actually eventually led me to an opportunity in the industry as the the first official troll for hire at Blockstream. So I had a bit of a short stint there, but I think it was very productive. Did a lot of good in terms of helping with the community effort with regards to the block size debate and all that, and sort of producing documentation and some write-ups about the entire debate. So that was definitely interesting. After that, I had a bit of a hiatus for a couple of years. The 2017 sort of bubble came along that allowed me to kick back a little bit, and I started getting a little more active again. I guess last year, COVID and all that, we were all kind of stuck in front of our computer with nothing much to do but start shit posting again. So here I am. I got involved again with the industry, with company I'll keep private, but it's good to be here. Interesting times. I mean, obviously with all that's happening, the way the industry has been growing, very exciting. Yeah.
Yeah. And I'm curious, would you put yourself in the Bitcoin maxi camp, or kind of where are you situated?
Yeah, definitely Bitcoin maxi camp. I tend to have a more, I think, a bit of a more open mind than others. I actually believe, and this is what led me to some of the stuff that we're talking about today. Is like if we're going to be sort of commenting and or even debating with other parts of the ecosystem, I think we owe it to ourselves, to have a better understanding, I think, of some of the other shitcoins that are around, at least to the extent that they make a claim to some of the properties that Bitcoin has. So, we've seen that with Ethereum sort of switching the narratives to their ultrasound money. And so there are a lot of people that try to refrain from entertaining these debates. They make the argument, of course, that Bitcoin and ETH aren't competing, which I think is fair. Ultimately, I do believe that as well. But unfortunately, they're sort of trying to hijack the narrative that Bitcoin's built. And so the new people that are coming into the ecosystem, I think, are owed some kind of explanation as to how both systems differ. And if we're going to get into that, and if we're going to come across as sort of rational observers, you want to have at least a decent grasp of what's happening on the other side of the field and be able to put forward better arguments. So here I am, yeah.
Yeah, great. So, today we're going to chat a little bit about why there are certain centralizing tendencies inside Ethereum. So, maybe you want to just give us a bit of a high-level overview. What's your thinking here?
Well, I guess it all began, with that massive Twitter thread that I put up. I mean, it's been a couple of months now, I guess. And I don't know exactly how I came around to this write-up. I think I had followed this idea of the staking derivatives, particularly the Lido implementation, and I had a sneaking suspicion that this was going to have a massive impact on the dynamics and sort of the incentives around the proof of stake proposition that Ethereum has. And then I encountered, or at least started digging in a little deeper into the whole MEV thing, as this was becoming a pretty hot topic in the Ethereum community. And what I found was, I think, pretty ugly, to say the least. And I also realized that some of the concepts behind it, and this was sort of validated by me putting this thread out, is there are not a lot of people in the Ethereum ecosystem that are actually aware of what's going on here. I mean, obviously, the more technical circles are keenly aware of it to the extent that they've fully recognized it as a challenge, and some of them are actually pretty worried about it. But outside of these circles, although it's been talked about in some podcasts, people have been putting out some articles on it. It seems very clear to me after putting out that thread that the larger ecosystem really did not fully recognize the challenges that this entire concept brought about. So I ended up just browsing through Twitter, digging through a couple of threads, and sort of highlighting what were those dynamics and how that could eventually play out. And I ended up realizing that the combination of staking, the combination of those derivatives, and the combination of MEV led to pretty grim sort of centralized forces that it seems to me will be dictating the future in Ethereum in some ways. And so I thought that was worthy to share. And given the reactions, I mean, this tweet's gotten almost 2 million prints now. It's still running. People are still retweeting it nowadays. I mean, I've had now, I don't know that I'm a Ethereum influencer now, but like I have had so many people, probably 4,000 more followers just from that tweet alone, and a lot of them were actually or at least seems to be Ethereum followers. So although I'm a maxi, it seems that people start valuing my opinion on those things. Not that I'm some kind of expert, but I guess it's worthy to bring some balance.
Yeah, so I mean, let's break that down. You mentioned three main ideas, which I think maybe it would be good to explain what those are, and then we can dive a little bit further into those. So you mentioned let's call it the interaction between three different things that are all combined in a way of centralization. So you mentioned staking, you mentioned also liquid staking or the staking derivatives, perhaps, and also finally the MEV concept. So could you just give, for people who don't know what this is, like if they just have only ever used Bitcoin and they've never heard anything about proof of stake, what are these ideas? The staking, liquid staking, and MEV.
Yeah, sure. Maybe we can start with MEV.
Yeah.
So MEV stands originally for miner extracted value. They flipped the term a little bit for it to mean sort of maximally extracted value or maximal extractable value. And people that are within Bitcoin only might not be too familiar because the fact of the matter is there's not many MEV opportunities within Bitcoin. MEV opportunities are essentially arbitrage opportunities that are offered mainly because of the nature of these smart contracting system, the EVM type, such as Ethereum, or really any platform that offers, large scale smart contracts, those decentralized exchanges and whatnot. And the nature of it basically is this. This is made possible because some entities have the opportunity to order transactions in a way that allow for them to essentially front run other participants in the ecosystem. So obviously, if you've got a decentralized exchange, then if you're able to place and given the transparency of these network, you're able to sort of observe and monitor any transactions that are going through these systems. And if you find an arbitrage opportunity that will allow you to capture a certain amount of value, then if you sit in a place where, as a miner, obviously, or anyone that's willing to outbid the other participants, and get your transaction in a block and confirmed before the other, and you're able to capture that value, sometimes to the detriment of the other participants. I think there's some arguments that some of the MEV is actually positive. It makes the markets more efficient, and I believe that that's a reasonable argument. But there are also some other concepts such as the sandwich attack, for example, that directly target users of these decentralized exchange, for example, and essentially create a situation where they're a victim of slippage. Whereas the sandwich attack would basically be that an MEV extractor targets a user that wants to make a certain transaction on these decentralized exchange, initially front runs that transaction so that the price of the asset that the user is willing to buy goes up. Because his transaction, the MEV extractor transaction goes in before his, then the user obviously ends up paying a higher price for the transaction that he was originally willing to make. And on the other side of that, it could very well be that the people that initially bumped the price of that transaction by front running him is actually the one that is selling him back the token at a higher price, capturing that inefficiency in the market. And because of that, you also have this dynamic where the people that are being front run, sometimes there's this entire sort of concept in Ethereum where, unfortunately, if your transaction doesn't go through, you end up paying fees nonetheless. And so, I mean, given the state of fees on Ethereum at the moment, which can be pretty high, especially on when doing those sort of swap exchanges regularly from $50 to $200, then people are victims of failed transactions. People are paying 50 to hundreds of dollars for transactions that aren't going through, specifically because they're being targeted by these sort of MEV opportunists. So that's, I guess, the basis of MEV. It's a pretty interesting issue. It is one that has effectively no limit in the way that it can be gamed, because the more applications that are brought about on Ethereum, the more different games and systems that are being developed, then arises more opportunities for MEV. And it's not very clear that there's really a solution for that. And so, yeah, I think that's.
Yeah, I see. So let me, I guess maybe it sounds as you're explaining it there, it sounds similar to what people might have seen, that whole Flash Boys story, or the whole idea of those like people who set up their trading right really close to a stock exchange, and they try to front run the incoming orders, and they try to basically beat sort of profit off of that. It almost seems like an Ethereum version of that, and like the certain tendencies that are being created by these opportunities, because now everyone is trying to go for some MEV. So let's talk a little bit about why it's not possible for them. Like, is it possible for this to be fixed?
I mean, it's sort of I think that's one of the biggest question that Ethereum is facing at the moment. And if you actually read some of the work of some of the people that are most involved in at least this. So to your comment, they're fully aware that there are parallels here to the extent that the biggest sort of piece of research that's been done on MEV in the Ethereum ecosystem has been released under a white paper that they call Flashboys, literally, or anyway, I guess the ultimate what came out of it was this concept of flashbots, which is one of the solution that they've brought forward, and it is a solution that allows for people to essentially bypass the public blockchain, the public mempool of Ethereum. And that came about because as these MEV opportunities started to arise, and mostly they did when DeFi started really picking up steam back in, I guess, last year. Then what happened is you had these people that started spotting those opportunities and started writing bots that would essentially try and outbid each other for those front running, those arbitrage opportunities. And what this essentially created is really an absolute bidding war on Ethereum, where the network started getting very quickly at full capacity. The fees started ramping up because those bots would obviously broadcast their transaction and consistently outbid each other. And so Flashbots was created to sort of work around that by creating this new auction system for MEV products, MEV extractors to essentially bundle transactions and propose them directly to the miners in a essentially off-chain. So they've created this network, they've created this sort of off-chain mempool, if you will, that allows these extractors to share their transactions, their bundled transaction, and bid for them without essentially filling up the Ethereum blockchain with those transactions and incidentally, raise the fees. It has achieved probably to a certain extent the purpose that it was designed to. So it has definitely, at least for a while, decrease the fees and the activity of these bots on the public Ethereum chain, but that does not without consequences. Because obviously now what you're left with, and this flashbot idea, this sort of flashbot protocol, if you will, has been adopted widely by pretty much all of the Ethereum miners. I think last time I checked, there was like an 85% uptake. Could very well be 100% uptake at this point. And obviously, the danger here is you've got a very permission network. So to be able to participate into the Flashbot network or protocol, if you will, it is completely permission. And it is also an obvious sort of central point of failure. I mean, this whole thing is ultimately hosted probably on AWS servers. And so you have this parallel sort of mempool that's running on Ethereum that's managing a significant amount of the Ethereum current sort of transaction economy, but that is fully controlled by a certain group of individuals. So obviously, they'll say like their incentive is for that network to keep running and be running in a way that's beneficial to the Ethereum ecosystem. But it'll be interesting to see how that scales in the future. Now, obviously, they've came up and they're still working on other potential solution to MEV. There's been talk of trying to make that network a little less permissioned and integrating it with, for example, Intel as a GX sort of secure enclave. So as to make it a little more, I believe, so as to make it a little more difficult for people to game that network. So that there would sort of be a cost of attack, is my understanding. And while that might be a sort of viable solution, you also have a problem where, I mean, it seems to me like it's the long running story with Ethereum is that they put forth solution, sometimes in a haste because they uncover a problem that needs fixing now. And by putting together that solution, they don't fully understand or study or care about the long-term incentives or the long-term consequences of these solutions. And by implementing those, then later down the road, they realize that they've only created more problems.
Right. Yeah.
I think generally the consensus within the Ethereum community, or at least some of its leading researchers, is that MEV is something that will be present possibly forever. There's no sort of catch-all solution to it. So this is definitely something that they'll have to deal with for the
Longer
foreseeable
term,
future.
yeah.
Yeah.
So then I guess is the argument essentially then that it causes this centralization, like I guess bringing it back to what's the problem, right? So I think centralization of the cryptocurrency is obviously an issue. And I think maybe this is a good point here, just to kind of spell out in 2017, there were big debates being had about Bitcoin and whether there would be centralization pressure. Maybe you could spell out some of those, even some of the different arguments I heard where, for example, that the additional latency caused by larger blocks would cause miners to have a centralizing pressure because they might want to be in the same location, which again is another centralizing force. Did you want to elaborate on any of those ideas in the Bitcoin context for, say, 2017, before we then compare it back to what's going on in Ethereum?
Yeah, so that was definitely obviously one of the concerns back then. There was a lot of work that was done in sort of trying to reduce that latency, and Bitcoin also had for a while its sort of parallel broadcasting network for blocks. Although the transaction broadcasting was still done on chain at the L1 level, but certainly yes, as blocks would have increased in size, then it would have created this issue where less well connected miners could have had their blocks orphaned because of the lack of better connectivity, and so it would obviously favor larger pools, and so would ultimately lead to consolidation of this hashing power. The obvious sort of other danger there was that by creating these larger blocks, you would make it sort of resource intensive for validating nodes for the individual that are running the validating nodes, and thereby again sort of compounding decentralization by making it more and more difficult. Obviously, I guess the small blockers won that debate, and we're well past that nowadays. I think it's pretty well recognized that the way we'll be able to scale is through layers. The situation is, although not entirely dissimilar, certainly a little different in terms of how MEV and the staking derivatives thing would play out. So maybe to introduce the staking derivatives idea, if you want me to go there, is
Yeah, sure.
so obviously with Ethereum considering probably actively moving towards the proof of stake implementation. It's not clear exactly when they'll get there. It seems like it's getting pushed back every other month, but that's ultimately their target. And the idea originally with staking is that it would require a sort of minimal capital amount of 32 Ethereum for an individual to be able to stake. And by staking, what we mean is that you essentially lock up, quote unquote, your capital into this contract that allows you to what they're trying to do is replicate the concept of proof of work, really, but using capital rather than proof of work energy expenditure. And so by allocating your capital to those staking contracts, then you get the opportunity to validate those blocks, those transactions of the network. And of course, because of that, you earn a reward. The reward being the issuance and the fees that come from the transaction activity on the network. Now, this obviously created this situation where it obviously becomes a little prohibitive for staking to be done if you absolutely need 32 ETH, which is about $100,000 at this point in time. And so people came up with ideas to sort of democratize, I guess, the staking activity. And one of these ideas are just staking pools. Staking pools are the first order solution where, just as with mining pools in a certain way, whatever amount of ETH you have available for staking, you contribute to essentially a pool of funds, and this pool of fund is sort of maintained by an infrastructure solution that runs their own validators. And so they'll use whatever ETH you have available for you to be able to participate in this activity. But people, obviously, Ethereum being Ethereum, people quickly wanted to see if they could come up with a sort of more, again, quote unquote, decentralized solution to this. And I think it's probably been a work in progress for a couple of years. But what they came up with is this idea of this decentralized staking protocol. So you actually have a contract that effectively does the same thing that a centralized staking pool would do. And so that they collect your Ethereum into this contract and they allow for anyone to be staking. Probably the most important or popular implementation of this in Ethereum is the Lido protocol. And so the Lido protocol, as in on one hand, yes, this staking contract that people can contribute to, but they also are governed by the Lido DAO, the Lido Decentralized Autonomous Organization. The Lido DAO has their own token, which is used for governance purpose, which allows the participants of this Lido ecosystem to sort of vote on proposals. But most importantly, the Lido sort of governance organization is the one to effectively select who are the validators that are sort of allowed to use the capital that is staked to the Lido contract and distribute that for staking. So there are several validators right now, not clear exactly what the amount is, but certainly half a dozen that are, but they're effectively, handpicked by this DAO organization. Obviously, we'll get into how this becomes very challenging going forward. But this is generally the idea, right? Is that you allow for democratization of staking by enabling anyone in the Ethereum ecosystem to be able to do this. Now, one of the other innovations that they've brought about is this idea of the staking derivatives. And the staking derivatives is a probably a game changer, really, in terms of the security infrastructure and the security dynamics of Ethereum, because the initial idea with staking is that you would freeze up your capital, and this Ethereum that is staked into validating contracts obviously cannot be used for other purposes. It is quote unquote dead capital. And so they quickly realized, though, that if you have this contract, then you can use that Ethereum that is staked into this contract and issue a one-for-one derivatives. So they have this wrapped token that whoever deposits into the Lido contract gets in return they call it STETH. And so this unlocks the liquidity. Obviously, this allows for people to not only participate in the staking, but then get a token in return that they can use to gamble away and use for all DeFi purposes, so as to try and compound the yield that they're getting.
So it's almost like it's like having your cake and eating it too. And because the craze is all about yield, and DeFi is it's like fiat degenerate gambling, but just put into the crypto world. That's like a weird way that this whole thing is growing, isn't it?
Well, it is. And I think, from my reading, I think a lot of people sort of anticipated those contracts, those staking derivatives to come along. It seems pretty clear to me that from day one, probably at least the smartest people in the room sort of realized that there were very real challenges to this. Because in a certain way, there's always been this talk with proof of stake of this sort of nothing at stake issue. And this really reintroduces this, staking derivatives really reintroduces this problem where, it really brings down the actual cost of staking on the system to the extent that they are potentially effectively negligible. And so a lot of the security design that was put into proof of stake, a lot of the sort of economic, I think, reasoning that was done initially always sort of accounted for the fact, or always sort of made the assumption that, only a certain proportion of people in the Ethereum ecosystem would be willing to stake, because it freezes up their capital. So you have this narrative that only the strongest bulls will be staking and whatnot. And this sort of really flips the script on its head, where you've created this opportunity for practically every single person, every single Ethereum token owner to be staking. And I think it's not well understood what the full outcome of this are from sort of a game theoretical standpoint. But I guess ultimately, this realization, this combination of the staking derivative incentive, this dynamic, and what I had previously also observed in the MEV sort of challenge really sort of reinforced my belief that it was inevitable, it seems to me, that proof of stake could potentially even be more centralizing than even sort of its strongest opponent would have anticipated. And we can go into how exactly that would play out.
So so proof of stake could be even more centralizing than its strongest opponent may have argued. So what are, I guess, some of the consequences of that staking centralization?
There are a lot. There obviously there are a lot. And so maybe before we go into exactly how or the consequences of it, I think it's worth highlighting again how these two
The
concepts sort of
interaction
compound
aspect.
the interaction
Yeah.
aspect exactly. And so starting with MEV, the problem with MEV is that it is a very, very, very specialized activity. I've sort of laid out the case before that as more applications come around in the Ethereum ecosystem, there's always new MEV opportunities that are being created. And for someone to stay on top of these MEV opportunities, it is a full-time job. It is an activity that requires deep knowledge of the Ethereum protocol in a way that very, very, very few people in the Ethereum ecosystem actually have. And so I think I put this quote in the original thread where it was an excerpt of a comment that Vitalik made on an article on Medium that sort of decried or at least complained about the sort of MEV situation. And I mean, maybe to quote him, but Vitalik himself said MEV extraction is naturally a highly high economies of scale and centralization pro activity. It involves writing and constantly maintaining advanced software. It's arguably even more high fixed cost than mining itself, and definitely more so than proof of stake. So obviously, given that fact, and given that MEV ultimately nowadays is what makes the difference between a hugely profitable Ethereum miner and a less so profitable one. And so the actors that will become experts at MEV and that will have the resources to constantly reinvest into this MEV activity will ultimately come out on top. And that will be even more through, and so one of my reasoning is that will be even more through in a proof of stake ecosystem. And one of the reasons why that is so is that the larger your stake is in Ethereum, the more opportunity you have to be able to capture this MEV. There's this sort of variance concept where the larger obviously the larger miners have an opportunity to create more blocks. There's this sort of randomized within proof of stake. There's this sort of randomized selection of validators that are adding blocks to the chain. Obviously, if you have more stake, then you're more likely to get picked, and then you're more likely to capture more MEV. And also within proof of stake, when they actually delegate the sort of at the station, when they actually delegate the block producers within a certain round, if you will, there's not only one validator that's selected. There's a couple of validators that are picked within a certain round. And if there's relations between those validators, there's opportunity for them. There's this sort of opportunity that's created within proof of stake for them that's not present within the current proof of work ecosystem that allows for them to coordinate around sort of MEV opportunities that can be executed across different blocks. And it really introduces sort of a new, not necessarily attack vector. I guess some people wouldn't be happy for me to call it that way, but certainly ultimately a way for larger centralized validators that are able to coordinate between each other to capture more MEV than their counterpart. And that is especially true within a staking derivatives environment.
Let me just try and explain that and make sure I've understood that. So the idea is there's this MEV. So this idea that by a block producer or a miner selectively reordering transactions, they could potentially benefit themselves by also concurrently going and doing trades on some of these quote unquote decentralized exchanges that allow them to front run the Ethereum transaction user at that point. And so what you're saying here is also that given the way the system is set up, it's very possible, and maybe we could argue even probable, that those block producers might then start collaborating with each other to start doing multi-block MEV opportunities or taking advantage of those, correct?
That is correct. And obviously, the obvious argument, at least from Ethereum proponent, would be, well, this would be detrimental to the system. This would, potentially bring the value of the asset down if people, if the block validators do perform those kinds of activities in a way that's too malicious. But I think there's a very fine line between sort of the profit incentive that is made available by these opportunities and the way, or at least to the extent to which the sort of ecosystem, the Ethereum ecosystem, is willing to tolerate it. And it's been increasingly blurry, and there's a lot of debate on both between some people in that ecosystem as to whether or not even just something like flashbots, sorry, is actually beneficial or detrimental to the ecosystem. But yeah, I mean, overall, the underlying bottom line is that the larger validator you are, the more stake you have within the proof of stake, the more MEV opportunities you capture, especially if you have, if you're sort of able to coordinate or collaborate, or if your staking infrastructure is created in partnership with, people that are very close to the protocol. And that's what we're seeing play out. Lido, for example, one of the main proponents of the Lido protocol is Paradigm. Paradigm is pretty well known, at least within the Ethereum ecosystem. They're not as active in Bitcoin, although they do, to their credit, I believe, sponsor a couple of Bitcoin developers. But all that to say is Paradigm actually bought 10% stake into the Lido DAO. And Paradigm has within its team, some of the most proficient Ethereum developers, some of the people that are closest to the core protocol. And so this allows them the ability to have a very deep understanding of MEV and the opportunities that might arise. And so you have, this introduces to proof of stake a sort of dynamic where you're not only concerned with your staking infrastructure and maintaining those computers on top of which the staking contract run, but you need to spend capital on this expertise of MEV. And obviously this capital might not be available to everyone, but the scarcity is very much in the resources that are available, the people that are actually able to write and execute the code that can capture this MEV. So that's the centralization dynamic for MEV. And then the relationship that this has with staking derivatives is basically that by allowing for a staking derivatives contract to be issued in exchange for staking your Ethereum, you create a network effect, create a liquidity network effect. And so it is not beneficial for people that are interested in those staking derivatives to be using derivatives for different providers. Obviously, if you have or maybe to jump back a little bit, like how does the staking ecosystem looks like nowadays? Well, to be perfectly fair, Lido itself, the protocol, is still a small fraction of the Ethereum that's currently staked into sort of this the beacon chain, they call, is this sort of pre-merge proof of stake contract. So it's still a very small fraction. It is the fastest growing pool of funds for Ethereum. I believe that I've read that in the last 30 days, 50% of the ETH that were staked into this beacon chain were actually staked into the Lido protocol. But nevertheless, right now, probably the most significant entities are exchanges. Kraken does a lot of staking. They have a significant portion. And if Kraken were to offer their own staking derivatives, then there's this situation, obviously, where the staking derivatives from Lido and the staking derivatives from Kraken, they're not fungible. And so no one is better off by using those different derivatives. These derivatives are essentially becoming the money that is available within the economy for Ethereum. So obviously liquidity begets liquidity, and so there's this very, very, very strong network effect incentive playing out. And if that holds true, and if Lido um, the Lido protocol, through their proficiency and their expertise, in being able to capture the MEV, become the sort of de facto staking protocol for Ethereum, then there's very little reason for anyone that's willing to stake to use anything other than Lido. And so it is my feeling that this sort of growth in Lido, and for people that are holding Lido token, that's probably very bullish. But it seems to me like there's this very, very strong incentive for people that are interested in, or all of the capital that is available for staking, to effectively converge with time into the Lido contract, because it has all the benefits of staking. It has all the benefits of sort of ecosystem integration, where they have, they allow you to use your ledger to be able to stake. They have all these integrations with all of the DeFi applications. But ultimately, their biggest value proposition is the liquidity that is created by their staking derivatives.
Yeah, interesting stuff. And so it's like, it reminds me of how our friends Marty and Matt over at Rabbit Hole Recap, they often talk about the centralizing pressure that proof of stake has even in the exchanges, because the exchanges might be holding lots of coins and giving incentives for their customers to leave their coins on the exchange so that exchange's staking does better. And so in what you're outlining here is like that on steroids, right? Because it's that another level, because now it's staking derivatives, which causes even more of a centralization pressure. So yeah, would you say that's an accurate summary then, or?
Definitely. And I think originally that was one of the concerns, right? And that's how people were seeing the proof of stake centralization playing out, is obviously you've got these massive amounts of ETH on centralized exchanges, and they're able to sort of offer that yield to their customer without their customer having to do much of anything. And it's not obvious, at least, that some of the capital would necessarily leave those exchanges, but it feels to me like the incentives are very much there for them to do so. And obviously, these exchanges, one of their biggest downside is that they're not able to offer. They're certainly able to offer sort of a similar derivative, in the sense that they can allow, at least even just within their own exchange, for people to have that ETH collateral in the staking contract, but potentially offer that derivative product on exchange. They could also have their own on-chain token, but obviously it's not as quote unquote trustless as the staking derivatives that's offered by an on-chain contract such as Lido. Something
Yeah.
else also that's very interesting, and sort of it really just only dawned on me in the last couple of days, that compounds the centralization effect, is that you have, I think it's always been very known, that this notion that the largest holders of this staking ecosystem, this sort of rich get richer effect, where they only have to sit on their coins, and then they continue to earn that yield without having to do much of anything. That's actually compounded by offering that derivatives, because then you unlock that capital that was originally set to be sort of dead capital, and you allow those people to use that capital and go back to the DeFi ecosystem, and potentially lend that capital on things like Compound, which is a DeFi app, and obviously, the more capital you have available to lend, the more profit, the more yield you earn, and so by the same effect, the more that profit you get, the more you can reinvest into staking, the largest your share of the pie grows. And so yeah, it's a very, very, very. I mean, it'll be interesting to see how it plays out. I can't claim that I predict the future, but I think there's a strong case to make that ultimately this all converges into a lot of the capital being, and this is not only my opinion. Funny enough, the people at Paradigm have actually put up a blog post in the last few months that outline this sort of decentralized staking protocol infrastructure, and they make the exact same case. They make the exact same case that there's network effect at play that could very well lead to up to almost 100% of the Ethereum being staked within the Lido contract. And they make that case, I think, without, at least in this article, without fully sort of acknowledging the sort of systemic risk that this introduces. And one of the one that I think they're definitely aware of it because they've just put forth a couple of weeks back a new article claiming how they would address this problem. And the problem is that if you have a majority of the stake that is allocated to the Lido contract, then the people that own the actual DAO token, the Lido governance token, are effectively the ones that are handpicking the validators for the entire Ethereum ecosystem.
Right, and that can be a problem, right?
That is a massive problem because this introduces even regulatory risk because some of the owners of this DAO contract are public-facing entities, and so by voting and by voting using their capital, they're able to decide who gets to potentially ultimately validate the Ethereum chain. And so, to be fair, again, they've acknowledged that risk. They claim to have a plan to sort of diminish this control that the DAO would have on the validator selection. They claim that they will use on-chain metrics to create a reputation system across the validators that will then sort of make it almost permissionless. I think if it works out, it's a pretty decent idea. But from my perspective, it's not within the incentives of the DAO token holders to enable that. Because if you create such a permissionless system, then the actual DAO loses all of its purpose. Because the governance ultimately of that protocol, the value that is essentially this curation of the validators. But then when you put this curation out of the hands of the DAO token, what's the value there? Why would the validators, this group of validators, decide that, hey, we don't want to pay any more fees to the DAO? Why would we share our revenue of the pie with people that are effectively providing almost little value at all? And so they might, and given obviously that these smart contracts are all public, anyone can copy and paste them. You've seen that with Uniswap and with the Sushi centralized exchanges. Like, why would the validators decide, hey, we don't need the DAO anymore? Let's switch to a new protocol, and then we'll implement this sort of permissionless curation system. And then all of the DAO token holders are left with nothing, with something that's worth nothing. So, it's not clear to me that it's incentives compatible.
Back to the show in a moment. Have you thought about upgrading your security to multi-signature? Unchained Capital are creating multi-signature vaults, and you can set yours up really easily. You can go to unchained.com and bring 2 hardware wallets and set it up for yourself. Or if you need help, they've got a concierge service. This concierge service can take you from having never held your own keys before to actually having your own multi-signature vault. And they've got different versions of this package where you can have the hardware wallets sent to you, or you can bring your own hardware wallets, and they will do a call with you and get you set up. And this is a great option to remove those single points of failure. This can also give you more peace of mind because you don't have to worry that just losing one thing makes you lose all your coins. Now you have some redundancy. So go to unchained-capital.com/concierge, get $50 off with the promo code Livera. My favorite hardware wallet is the Cold Card by coinkite.com. The Cold Card is a specialized Bitcoin hardware wallet device that you can use to generate private keys or store your private keys and sign a Bitcoin transaction. And you can sign those Bitcoin transactions using a micro SD card, meaning you never have to actually plug your Cold Card into a computer. So don't be worried. There's lots of instructional videos. There's ways to do it, and you can use it easily with wallets like Spectre Desktop or Sparrow or Electrum or even Blue Wallet. So go to coinkite.com and use the code Livera to order yours. And lastly, don't forget about doing your backups. Could you recover your Bitcoins if your house went up on fire? This is why you need metal seed backup products like the Cipher Grid from cyphersafe.io. This new product coming out is the best value in the industry. You get everything you need for $59. It's BIP39 compatible, so the standard 12 or 24 word seed words, and it's got privacy by default. The two plates are facing each other. You can lock this one with a padlock. You get a tamper evidence seal and an automatic center punch provided also. And this product is fireproof, rust-proof, and waterproof. So if you need yours, go to cyphersafe.io and use the code Livera to get a discount when you're ordering your one. Back to the show. Yeah, so fundamentally then it points towards more and more centralization in the Ethereum system. And so if the Ethereum validators end up being handpicked, what are the consequences of this?
Yeah, well, obviously, at face value, some of the consequences are pretty obvious. You have this organization, like I said, that it effectively devolves Ethereum into what is essentially called a sort of a DPoS system, a delegated proof of stake system. Delegated meaning that those who those who hold the coin actually get to vote on who is validating the chain. We have some experience with these DPoS systems. They're not very decentralized. The target that is put on the token holders is a lot more obvious and a lot more pervasive than they are within a sort of or at least the current sort of proof of stake implementation of Ethereum. And one of the main danger probably is that this very strong potentially challenges the claims of Ethereum with regards to their monetary policy.
So it's not ultrasound money.
Well, I mean, exactly. They already have this this history of switching their monetary policy around in different ways. Now, their claim is that they always have targeted a sort of more deflationary issuance. They have this concept that they call the minimum viable issuance, which is sort of very hand wavy implementation of something that has actual no inputs. It cannot be codified. It's something very, very vague, but obviously their target and the narrative that they want to entertain is that you will end up with a system that's deflationary, and at least their argument lately has been that this EIP 1559 that has been introduced is the last change they'll make. It's probably the argument is that the monetary policy of Ethereum will calcify after this because we have all the tools that are needed for us to probably go into the long term and have an incentive compatible monetary system. The problems that I see with that, obviously, is that if you concentrate the validator set, and especially if you allow for most people, potentially 100% of the people in Ethereum, to be able to validate, the more people that are validating, the less stake the less issuance, the less rewards each individual player actually is rewarded with. And so you could come to a point in that sort of dynamic down the road where the validators aren't too happy anymore with their rewards. They might get to claim that the issuance is not enough for them to be incentivized to actually stake. They probably are earning more stake within potentially DeFi activity. And so they will say, well, we're and this by consequence, the Lido set of validators that potentially is very centralized will say, hey guys, we've got to flip the monetary issuance around a little bit. Let's increase that by a couple percentage point. Like, what's the big deal, right? You're going to incentivize us to continue staking, and everyone will be happy. And if the history of Ethereum is to be trusted, I guess, it's not clear that by the time this happened and the scale at which Ethereum community will be, it's not clear that everyone will sort of raise up and work against that. because there's a very real danger that you're effectively raising up against the overlords of the system. By the time the validators become that big, especially if it's concentrated against such a small set of validators or even just a single protocol, it becomes a very risky business to say like, hey, just f off, like you're not going to get what you want, um, because then you know then they might decide, the validators might decide, okay, well, we're not going to get the issuance change, but then watch for your sort of MEV, watch for your transactions. Like we're going to be doing, like we had previously sort of avoided doing detrimental MEV activities, but we need more revenues. So we're going to do whatever we need to get those revenues. So it's a challenge. And also,
Yeah.
like one of the things that the validators do, one of the things that is an obvious downside to Ethereum that's always been very clear to me, is that the miners in Ethereum actually control the block size. They get and what they call the gas limit is effectively decided by the miners. Historically, it's been something that was done in coordination with the Ethereum Foundation, the Ethereum core devs. The Ethereum core devs would say like, okay, we feel that it's safe to increase the block size a little bit, and the miners would be compliant and say, okay, let's do that. But then if you and to my knowledge, this is not going to change with proof of stake. And so obviously, if you have, again, this usually centralized entity that control the block size, like what's to stop them from increasing the gas limit, thereby not only concentrating the validator set, but also it's important to remember that although there are these validators within Ethereum, there's also supposed to be this sort of dynamic, this balance of power, where you also have the Ethereum nodes, the validating nodes, the ones that supposedly everyone is able to run. Obviously, we all know that that's a big challenge within Ethereum itself already at this point. But down the road, this the validators are giving the opportunity to blur this sort of diminish this balance of power and concentrate their control even more by slowly pushing out at the edge the validator set, so that down the line, who knows? Maybe they'll be the only ones, like the validators themselves will be the only one able to run Ethereum nodes, at which point there's effectively no distribution of power. You have
Yeah.
this one single entity that controls all the rules within Ethereum.
Yeah, it just seems to me like it's recreating the fiat world. It's just recreating all the problems that we don't like about fiat, and it's just, well, I mean, look, the ETH huffers might have some counter argument here, so but fine, whatever. And now one other idea as well, so related to this centralization idea. What about in the case of some big failure? If there were to be some big systemic failure or some kind of network split, could you elaborate a little bit on that and what the centralization of Ethereum might mean for that?
Well, I think that's one of the biggest downside of proof of stake, and it's funny. This topic this topic came up last night. So you had Dennis Porter had a bit of a debate with David Hoffman from Bankless, from the Bankless podcast, and this exact conversation came along, and it was a little astounding to hear David's reply. And effectively, for proof of stake, there's no answer, because if you dig a little bit into this entire concept, if you dig a little bit into the proof of stake implementation, it's sort of a weak. They refer to it as weak subjectivity. So it doesn't actually secure the past. It only really secures the present. And so, at a certain point in time, if the network forks, and especially if the network splits, the longer the network split, the harder it is for the network participant to be able to ascertain exactly which chain is the valid one. And so by that effect, if ever this happens, And obviously, so David's answer to that basically yesterday was, well, the community will just get together and will make a decision as to which chain is the valid one. Well, first off, obviously, if you're going to do that, you need to be validating the chain. You need to be actively running a node, which might get further and further more difficult down the line with Ethereum. But also, and I guess this is one of the answers that comes along every time that an issue is brought up with Ethereum, is the community will figure it out. Everyone is working within Ethereum's best interests, and so its participants will figure it out. And it's very obvious to someone that sort of studied these systems and actually understand why they were created in the first place, is that because the concept of community does not scale. You cannot reach, there becomes a certain point in time where the community becomes too big. It's like saying, if the internet breaks, well, the community is going to figure it out. Who exactly is who's the internet community here? Like it will start losing value. It will start losing sense in the future. It is already sort of it's already happening. Even within the Bitcoin ecosystem, like you have different factions. People are getting interested or excited about certain projects. Some people are not, and that's good. That's healthy. That's decentralization playing out. But decentralization ultimately brings about an inability to coordinate, and so obviously then what happens if something if a split happens within proof of stake? Well, since there's no sort of objective measure of that you have with proof of work, with the weight of the chain, if there's no objective measure of which one is the valid chain, then it all comes down to a sort of popularity contest. It becomes who holds the most ETH gets to decide, who are the biggest validators. Again, they get to decide which one is the valid chain. And it doesn't matter if it isn't. Basically, if they're the provider of all the infrastructure, you really have no choice but to play along with them, because otherwise you're left with a chain that has very little security or very little actual capital dedicated to them. So that's a major concern. I don't know how to get around this one. I think it'll become increasingly obvious that the community answer is not going to cut it. And so, yeah.
Especially if there's competing interests, because there might be people, okay, if like supposedly if Ethereum is going to be the whole smart contracting, so on, and there would be people on different sides of the argument saying, hey, I've lost this much money, and the other one would be saying, no, I'm going to lose all this money. And then it's going to be like, well, whose interest do we protect? Does the community decide? And then what are they even protecting at the end of the day?
Exactly. And I think it's interesting that you bring up this argument, because from my perspective, we're seeing that split already sort of occurring in the Ethereum community, where they've introduced this sound money narrative, this ultrasound money narrative, because they see how well it's working for Bitcoin. The number go up, that's working well. But on the other hand, you've got this dynamic right now where the actual original utility use case of Ethereum, the ability for people to perform economic activity on the chain through whatever DeFi app or whatever it is, it's become challenged or challenging because of the fees on the network. Obviously, they'll claim that they have a solution to the fees on the network, but you're seeing this divergence already from people that are just interested in minting those NFTs, trading those NFTs around, using those DeFi applications, speculating in such a way that it is becoming uneconomical to do so on the Ethereum chain. And so that is why you're seeing this emergence of these alternative
like
layer
Binance
ones.
Smart Chain. Yeah.
Binance Smart Chain, Solana, Polkadot, and all of that. And so you have this divergence in interest within the Ethereum community already of the sound money proponent. And for the sound money proponents to be correct, or for they claim to be validated, you sort of need high fees. They really want higher fees, because the higher fees they have, the more Ethereum gets burned, and so the more deflationary it becomes. But then on the other hand, you've got these other guys that just want to be able to transact for as little fees as possible. They want their activity to be as efficient as possible. And so they'll gladly move their activity across different chains if it allows them to do that. And so, like you said, down the line, competing interests, what happens is if there's a fork, it's not clear that everyone will sort of reconcile together. So you might be left with ultimately two different chains.
Yeah, and that's just not that's not a winning outcome for them. And it potentially, I think you were touching on this before, that it might be painting a regulatory target on the back of Ethereum companies and Ethereum entities as well.
Definitely. I think there's a lot of ways you can conceive how this could happen. I think one of the obvious way, and I'm not one for supporting regulators to attack these networks,
Of
because
course. Yeah.
you don't want to play favorites. Obviously, if they start being adversarial towards one network, nothing's stopping them from being adversarial towards Bitcoin. But the target is just there for Ethereum, and it's increasingly the case if you consider the DAO organization, because it's very clear to me that the DAO token is obviously a security. It is inarguably a security. It is something that allows a claim on future rewards that is offered by, it is offered by a ultimately in the beginning centralized team. Of course, now that's the whole idea. They sort of distribute this token within the ecosystem, and then they get to claim that, oh well, it's centralized. There's no centralized issuer, so it's not really security. I don't think that's a very convincing argument for the regulators. But ultimately, even if it's not a matter of securities, you expose through these organizations, through those validators. The validators in Ethereum, these are keys. This is capital that's held on servers that needs to be online 100% of the time, 24/7, because if there is any downtime to their activity, there's immediate repercussions for them. There's this concept of slashing. If you're a validator and you go offline and somehow that has an effect on the network, well, then you get to pay for that. So they need so obviously then this entire infrastructure, it becomes a little hard to be able to manage that without putting a regulatory target on your back. Some people will say that it's the same for mining. Obviously, mining being large operations, they're subject to sort of government enforcement. We've seen that with China, and it's going to be interesting to see how exactly it plays out. But the one major difference really is that with mining, well, the government might come along and say, okay, well, you got to burn your mining facility down. I'm sorry, there's nothing we can do. Ultimately, yeah, obviously the miners are affected. This exact miner is affected. Potentially, the security to a certain extent of the network is affected. But ultimately, other miners will come up to pick up the slack. The problem with the Ethereum staking nodes is that you hold the private keys there, and if this gets compromised, and that's why some of the arguments about potential proof of stake attacks from the validators, the argument is always that, well, like miners, they don't have the incentive to attack the network, and so they'll play along and they'll be nice to everyone. But the problem is that if you paint a regulatory or sort of a adversarial target on your Ethereum staking nodes, well, if someone comes along, not only can they burn down your infrastructure, they can actually steal. They can actually compromise your private key. At which point they control directly the capital. And again, they can sit on that capital perpetually, sort of reinforcing their control, their control over Ethereum.
Yeah, it's pretty concerning stuff. Well, it should be very concerning stuff for any ETH person or proponent. And so I think to contrast with Bitcoin as well, because obviously this is a Bitcoin show, and I think the idea is to give people some context or give them some ideas on what are the differences there to understand how is Bitcoin structured differently. So maybe one area would be to contrast with Bitcoin miners. And so obviously Bitcoin is openly a proof of work system. Do you want to outline any differences there?
Yeah, well, there are very major differences, and this comes back to what I just said. Is there's this notion of, and especially true. You said the exact same thing earlier. Especially true with staking derivatives, where there's kind of a free lunch dynamic playing out with staking, where you capture this capital over time. You might already have this capital from, ICO days, like how much percentage of the Ethereum that's been allocated to certain entities and that they've been sitting on since essentially the ICO. And not only probably have they been sitting on them, but this was essentially free capital for them to down the line leverage during the ICO boom, the DeFi boom. So obviously you have this concentration of this concern about the concentration of capital. And what happens is that the way staking is designed is obviously that you have no expenditure to maintain that validating infrastructure. You sit on your capital, again, increasingly true with the derivatives. You sit on your capital and you earn more rewards. It's a bit of it's a bit of a Cantillon effect at play, really, and something that Bitcoiners will be obviously very familiar with. But like you said, it really creates a very strong parallel between Ethereum, as it is designed to turn into, and the fiat system. And the obvious difference, as you point out, is the permissionless aspect of the proof of work. We've seen that throughout its history. The biggest miners at a certain point in time are the biggest miners at a certain point in time. If you look at the ecosystem 4 years afterward in the future, they might not even exist anymore. Like there was this entity back in 2013 or something, like Ghash. They controlled up to a point almost 51% of the actual hashing power. And you look at it today. There's no Ghash on the network anymore. And I mean, you had Bitmain for severe, like a very long period of Bitcoin history. Bitmain through the end pool, they controlled a significant stake in the mining infrastructure. Well, who's the leading miner nowadays? The leading mining pool? It's probably just it's probably moving. It's a little volatile, obviously. But recently, Foundry, the mining initiative from DCG, from Barry Silbert and all, actually became probably the first mining pool, the first American mining pool in Bitcoin history to actually hold the #1 place. So it's a very competitive environment. And it's increasingly the case and it will actually, become increasingly the case in the future when margins will probably go down. Nowadays, miners are enjoying a very, very, very preferential sort of dynamic. That's especially true because of what happened with the mining shutdown in China, where the difficulty went down so much. The existing miners, the margins are ridiculous. It's not going to stay the same for a long time. Down the road, as mining further and further professionalizes, the margin will be razor thin, and then so it becomes a game of who's got the cheapest power, who's got the lowest capex, who's got the most efficient machines. And so it's a situation that's always in flux. And so you never have this one miner that will have a stake on the network that they can never where no one can replace them. So it's a massive, it's a very beneficial aspect of proof of work. It's actually how it thrives toward further and further decentralization, is it becomes this very capitalistic system where people have to become, specialized. They have to continue to expand capital to be able to stay in this game and earn the rewards of Bitcoin mining.
Yeah, excellent points all there. Essentially, it's Bitcoin mining is a hyper competitive environment. You need to be, and it's constantly changing. And as you were saying, it's constant expenditure, right? So capital expenditure and operating expenditure, because you're buying new machines, you're paying for power, you're paying for rack space, you're paying to get all of the things done, to get maintenance, all of these aspects. It just requires constant expenditure, and there's constant competition happening. So that element is further decentralizing over time compared to Ethereum, which is further centralizing over time. And then even with Bitcoin being formed with that 21 million from the start aspect, I think that's also an important point that people maybe are taking that a little bit for granted in this conversation and just thinking, oh, well, see, ultrasound money, I'll just make this money that's going down to try and, but ultimately the point is that you're not changing it. Like Bitcoin's
Exactly.
supply is not going to change.
Exactly. I think this point cannot be emphasized enough. And I've actually lately been sort of trying to introduce this different uh, framing with regards to Bitcoin's distribution, because I think it's very valuable in terms of contrasting it with Ethereum's monetary policy. Um, and the idea is that Bitcoin does not really have a monetary policy. Bitcoin was built with a distribution schedule. Satoshi decided there's going to be, it's more of a like a first principle design axiom where Satoshi decides that there will be a hard cap, decides how many coins there will be in Bitcoin throughout its history, and then builds a distribution curve around that. And it's very important because it sort of, to me, it sort of really defeats the argument uh, that a lot of people in Ethereum make, where, oh, well, Bitcoin has this monetary policy, it's not guaranteed that in the future it'll work, because what if the fee revenue is not too high, the fee revenue being sort of an uncertainty, then it's likely that Bitcoin changes its monetary policy to adjust, potentially with more inflation. But really, that's a non-starter. Like I said, it's a first principle design that Bitcoin was built with a hard cap. And the assumption is made that if Bitcoin is to succeed, it will obviously, as the standard for transfer of value across the world, generate a ginormous amount of fees for miners to be incentivized to secure the network. And if those fees are not enough, if miners aren't incentivized, it is not a it is not a reflection of the security model. It would simply be a reflection of Bitcoin failing to monetize. And so the assumption that somehow there's a flaw in the security model, in the fee-based security model, is wrong. It is only true if you assume that Bitcoin fails. And if Bitcoin fails, it's because as a store of value, it has failed to build a network effect and to monetize into the real world. Um, so you have this fee-based market mechanism. There's no right amount of security. That's another major misconception that people always make to me. You cannot say whether or not Bitcoin's got too much security or not enough security. It has just as much security as the market is willing to pay for. If the market doesn't value Bitcoin to the extent of the hashing power that is active on the network, the value of the asset will go down. The miners will be disincentivized, will have to turn off their machine, or people will be paying less fees. So it's not a problem. Like, again, this comes back to the argument: if there is low fees on the Bitcoin network and the people and miners aren't incentivized to mine, that's because ultimately there's low demand for Bitcoin. That's where it ends. And so to contrast that with Ethereum, um, rather than having this distribution schedule in Bitcoin, where there's a very strong commitment made to distribute the monetary asset within the ecosystem, and then let the market figure it out. Well, with Ethereum, like you said, they've made this sort of commitment to a policy, and policies are not set in stone. Policies will depend on inputs, outputs from the system. And it seems, I mean, it's a bit bewildering to me. Whenever you hear Ethereum, most Ethereum proponents really talk about this, is that it's very much a fiat mindset. It's total Keynesian arguments really that are being made, where they will adjust according to what the result of their experiment is. And again, they make the argument, well, if it doesn't work, the community will figure it out. But the whole point of Bitcoin, the whole point why we have this system, is that we want to remove the human element from this conversation, because the human element has failed us repeatedly through history. And so it doesn't matter that they claim that the current policy that they have is deflationary, because they've created this opening for them to be able to change it down the line. And if it can be changed once, it can be changed twice, and more and more and more. And the point I want to make also, and I think people might understand it better also, or at least to bring it back to Bitcoin, there's this notion, there's this notion that's always talked about of what if Bitcoin was built with a 1% sort of emission schedule, an eventual 1% inflation schedule. Would it be as sound money as it is without without the hard cap that it has today? And a lot of people make the argument, well, it doesn't matter as long as the rules are set from the beginning. If it's 1%, 5%, whatever, the market will decide whether it accepts this proposition, and it will, as long as it stays set and there's no historical precedent of it changing, then it will remain the same. I reject this notion very strongly. And the difference between 0 and 1% or half a percent is all the difference in the world. Because the 1% introduces a monetary policy, right? The 1% says that we cannot rely on market functions to be able to value the asset and the demand for the transaction on the network to be able to secure it. So by introducing this monetary policy, then you open the Pandora's box for it to be able to. You create a sort of shelling point where it becomes easy to open an argument against down the line, where people might feel, okay, well, turns out 1% is not enough. We have an inflation rate, so might as well play around with it. So I think it was a non-starter from the beginning. I think Satoshi very much understood that notion. And that's why the hard cap is fundamental to the design of Bitcoin. I believe it would not have garnered the adoption that it has up to this day without a hard cap.
Yeah, yeah, really interesting stuff. And I think it's like just that discovery of the number 0. And I think Breedlove has written about this. It's kind of like this idea that even in maths, people weren't necessarily like it was an interesting article that he wrote about the discovery of the number 0, and I think that's very related to the point that you're making. And so I guess summarizing things in terms of what's the future looking like for Ethereum and its centralization, what do you see for that?
Well, one thing I see that people or Bitcoiners won't really be happy about is I expect Ethereum to stick around for a while, because the way it's designed is sort of this same a bit perverse design that the fiat system is built, right? Where you know that it's fundamentally flawed, but it takes a while for these incentives to ultimately play out. But what I see as the real danger, and I think we've discussed that, and we're seeing that emerge. And I'm also observing people that are usually like the flag bearers of Ethereum, some of the influencers within Ethereum. They're starting to have this sort of sneaking suspicion that they've put themselves between a rock and a hard place, where, like I said, either they entertain the store value narrative, but if they fail to do that, and ultimately I think we agree that they will fail to do that. I don't think the market ultimately will buy this argument. They might sort of be able to entertain it for a while, but by having so much of these fees being burned, so much of the Ethereum being burned. So from a supply perspective, it's absolutely possible that for at least a short amount of time, the supply becomes constrained, and the number goes up, and then they can play along with that narrative. But the issue is that if they fail to establish this sound money narrative, all they're left with is the utility narrative. All they're left with is the application layer narrative. And the application layer narrative is a death sentence, because the application layer narrative is a technology narrative. And so when people, used to say in the past that Bitcoin is the MySpace of money, I mean, we all know why that's wrong. But Ethereum, on the other hand, and it's funny, I think you had who was it? I think it was Paul Tudor Jones that was on Bloomberg, or who's the one? Anyways, one of the major sort of TradFi investor that actually owns Bitcoin. He was making the exact same argument: is that actually Ethereum might just be the MySpace of its ecosystem, because if you're hanging on to technology as your only value proposition, then that's a very, very sort of weak grounding, because as we all know, technology is improving, it's iterating every single day. And so you already have the Solanas of this world. You already have the Binance chain. Now, people might say, well, Binance chain, obviously very, very centralized. So potentially not a viable competitor to Ethereum. Same could be said about Solana. But who knows how? Who knows? Sorry, it was Drunken Miller. It was Drunken Miller that made the exact same analogy to.
Drucken Miller, yeah.
Yeah. Anyways, and so there will be better technology for the DeFi applications that will come along. There will be better technology for the NFTs application that will come along. And so this will inevitably dilute the market cap of Ethereum. Because if they don't monetize, if the monetary premium is removed from their value proposition, then it's who gets the best tech. And as we all know, it's pretty much impossible to hold that lead forever. And if you create a precedent where you lose that lead, then you create a precedent where people will not be willing to invest. It's the flippening argument, and the Ethereum people think that the flippening argument would be good for them, but obviously the obvious response to that is that if Bitcoin can be flippant, then so can Ethereum. And at this point, who will be willing to trust their money into any of these systems, because they might always be at risk of being flippant, and then you've got this sort of musical chair around where who's the last that will be left holding the bags. It's not a very favorable scenario, especially if tech is your only value proposition. So ultimately, I see that as how it plays out. I think Ethereum stays around for a while. I think it
Yeah, really
enjoys.
interesting.
I think it enjoys some temporary success for probably several years. I mean, success in the terms of like, money being tossed around and sort of. I mean, they're enjoying the same in a way. They're enjoying the same byproduct of the fiat system that as Bitcoin is, where there's so much liquidity around.
Mm.
So why wouldn't you, buy a picture of a rock for $500,000 for you to be able to flip it to someone else for $1 million? But when ultimately, I think when that liquidity dries up, that's when Ethereum will be on very, very shaky grounds.
Yeah, really interesting way to summarize it, because I'm thinking now back to some of the early writings at the Nakamoto Institute, where the boys there were writing articles like app coins or snake oil, or pointing out the problems of utility tokens. And as you were rightly saying, Ethereum doesn't have a chance at winning the store of value, quote unquote. I mean, that's what kind of the VC shitcoiner people is, oh, that's store of value. But really, it's just money, right? We're just trying to win. We're just trying to create money, like reliable, open money. Anyone can run a node. Anyone can use Bitcoin. Anyone can validate the full 21 million coins. Like that's really what is, that's the Bitcoin project. Yeah. And of course, there are different ways you can use Bitcoin, but that's the broad idea of Bitcoin, where there's this 21 million, and as we're saying, it's a distribution schedule. Whereas with Ethereum, they can change that money supply. So they're just not going to. They're never going to win that. They're never going to become that. And then if they're just trying to be a utility, well, there's a lot of already well documented and known problems with utility coins, because somebody else can just go and make a technology that does it cheaper, or does it more centralized and faster or better, or some different new way. So there's really a lot of problems there in that way. And I love the MySpace of Ethereum is the MySpace. Actually, while we're here as well, I'm curious, do you have any thoughts on, I think, what I believe is the OG critique of proof of stake, which is the Nothing at Stake paper? And I believe it was Andrew Polstra who wrote that in, I want to say 2014. Do you have any thoughts on that? Or how well do you think that paper holds up now?
To my knowledge, and I have to revisit, I haven't read that one in a while. To my knowledge, it doesn't hold up as well for the fact that it didn't account back then for the sort of implementation of slashing that Ethereum is with. Like, it didn't account for the proof of stake implementation that Ethereum is now proposing. So there's still, I believe, some value to it. And I'd encourage anyone to read it because it certainly gives a sort of very intelligent perspective on the challenges of proof of stake. But I think some of the arguments break down a little bit, especially when it comes to how Andrew proposed that there is not necessarily a cost to attacking the system. It's not clear that like what Ethereum has come up with is a perfect solution for it, but it's a different sort of scenario. So I don't know that we can evaluate it under the same lens. Yeah.
Gotcha. And I mean, in fairness, it is what, 7 years old or something like that now. So that was quite a while back. But I think the arguments that you've presented today certainly make a lot of sense to me around centralization pressure that is simply there in Ethereum. So did you have any, I guess, final comments you wanted to make on this whole topic?
Well, I mean, ultimately, I think I've said all that needed to be said. I think I would encourage, what I would want to say is that I would encourage, and this is what I said in the very beginning, is I would encourage people to start, and if you're going to get into these conversations, I think you owe it to yourself to get a little more knowledge about exactly how these systems are designed. I mean, you might think that it's not worth your time, which is perfectly fair. I would encourage anyone that's working, on anything productive within the Bitcoin ecosystem, and that's not just like shit posting on Twitter like I am every day, to not bother with that. Continue doing what you're doing. You're doing well. Continue writing code. We don't need you. I'll handle the arguments on Twitter. But for anyone else that sort of gets into these conversation, I'm afraid a lot of times we end up looking a little bit silly. The Bitcoiners, and I mean, there's a guy called Eric Wall on Twitter. I think this Norwegian guy. I think
Yep.
he often makes the argument. He's made the argument in the past that a lot of Ethereum people actually probably know more about or understand Bitcoin better than Bitcoiners give them credit for. And the same is not true. A lot of people, and especially unfortunately, like from this sort of last batch of Bitcoiners, they've been ingrained, with this idea that Ethereum is evil, but they actually understand none of it. And so when they come around to discussing it, they're especially if there's an audience, if there's people that are kind of new to this ecosystem that end up overhearing those conversations. From my perspective, and if I was that person, I would think that Ethereum's definitely got something going for itself, because the arguments that I'm hearing from the average Bitcoiner on Clubhouse, not very convincing, sometimes pretty embarrassing. So again, if you're going to sort of critique those systems, you really should just dive a little more deeper into them so that you can actually have, an intelligent conversation. I mean, I've been getting into arguments lately with people in the Bitcoin maxis, because I think there's some value to the NFT idea. I think 99.9% of it at the moment is completely speculative. It's a bubble. It'll pop. And also, it's worth pointing out, NFTs ultimately is not a moat for Ethereum, and people associate it with Ethereum so much that they don't think for themselves and use sort of a rational mindset where they evaluate the idea on its own without, immediately saying, well, it's from Ethereum. It's total shit. There's no interest here. Personally, I think some of it is pretty tenable. But then I'm always, like I said, I'm always faced with these conversations of people just being blind for no reason that, they've been, it's sort of this conditioning that we've created throughout the years with people that are new to this ecosystem, this sort of toxic maximalism. And I'm all for toxic maximalism, but I'm also all for sort of critical thinking. I need people to not trust the oracles and not trust me or someone else
Yeah.
to tell them like
Okay.
this thing is bad, don't believe in it, don't trust it. No, you need to come to these conclusions on your own. You need to think for yourself. And so whenever you encounter a subject like this, yeah, just bring some rational thinking to the table. You'll be better off for it. Everyone will be better off, and your audience, if there is any, will benefit.
Gotcha. Yeah, so I think, and for listeners out there who just think, look, all I care about is sound money, that's fine. Then just don't worry about anything else. Just focus just on Bitcoin. And then I think maybe one of the lessons of this episode might just be that here are some ways to think about a more like an intelligent critique, basically. So if you're going to be talking about Ethereum, maybe if you can offer a more intelligent critique, that's probably the better way to go about it. So that's probably a good spot to finish here. Alex, where can people find you online if they want to follow you or see your work?
Twitter. Twitter is the probably the place where I'm most active. So you can find me at Berge Alex 4. That's BERGE Alex 4. I'm happy, always happy to chat with you. You'll see I'm pretty active. I mean, I have some comments, some tweets. I'll rub people the wrong way, but that's the nature of this ecosystem.
Fantastic. Well, thank you, Alex. It's been a pleasure chatting with you today.
Same. Thanks for the time. It was very, very, very interesting chat. Have a good one.
Get the show notes at stephanlivera.com/303, and you can also find a transcript there shortly. Thanks for listening, and I'll see you in the Citadels.